Hello everyone, and thanks for joining us for another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. So what do we have on tap for today's show? Well, we're going to be talking about the empty nest syndrome or lack thereof. We've talked about a lot on this show, the idea that many millennials at an age where you would expect them to be out of the house and financially independent are unfortunately, from a financial standpoint anyway, returning to the nest. And there's a new study out that suggests that this trend is continuing. So I wanted to share the numbers with you as we continue to follow what I think is kind of an interesting story. We're also joined by our tax pro, none other than Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. Greg is here to talk with us about some tax-advantaged ways to pay for your medical expenses. So we've talked a lot about Healthcare Affordability Act and things like that. That is not what the subject of today's interview is going to be about, so you're going to want to stay with us for that. And interestingly, another topic that I'm going to talk about is the fact that the IRS has recently become somewhat more lenient on the rule with respect to 60-day rollovers of IRAs and 401ks and other pension plans. So we'll go over briefly what the rules are and discuss how they've become a little more lenient with how they follow those rules. And then finally, we have a viewer question on making a major luxury purchase and whether or not they can afford it. So we're going to help them unravel that mystery. So first up, we've talked a lot about what we call the boomerang generation, what would normally be kids of what many parents would hope would be their empty nest, these kids going off to college or maybe entering the workforce as adults, but remaining on the family payroll, so to speak, whether it means that they actually come back and live at home or to some other extent the parents continue to support kids on an ongoing basis, whether it be cell phone bill, food, car payments, health insurance, things along those lines. So a couple months ago, we talked about a study that was done by Bank of America, and they indicated that parents were increasingly of the opinion that it was harder and harder for their children to become financially independent. And of course, the important financial ramification for this is, one, for the parents, if they have to continue to subsidize adult children's lives, it's going to be difficult for them to reach financial independence and to retire if they have to continue to pay bills that perhaps they weren't expecting to have to pay in their later years. And of course, it's also a problem for the millennials. You know, we look at kids that leave the house, we want them to lead independent and financially healthy lives. And if the economy is such that they're not able to do that and they continue to need the support of their parents, there's probably a problem there. So it's really a twofold problem that we want to keep a close eye on, and the Bank of America study indicated that parents were definitely feeling the pinch. Well, there's a new study out, and this one is by an organization called Society for Grown-Ups. Now, it's based up in Boston. It's a financial planning organization, and it's backed by Mass Mutual, which, as many of you know, is a large insurance company. And they commissioned a study where they surveyed 1,000 individuals, age ranges between 21 and 45, and they came up with some interesting statistics that I wanted to share with you here, and I think these bear out some of the earlier things we've talked about. So let me throw a slide up and we'll talk about it. First up, 35% of those surveyed indicated that they were still receiving financial support from their parents. This is really a stunning number. Over a third of those people between 21 and 45 still receiving financial support from parents. The next detail, 70% of those people, so those people that are receiving financial support, indicate that they couldn't get by without it. So it's not just a matter of picking up a car payment once in a while or paying for, the cell phone. This is the type of support that they depend on in order to continue to lead their lives. If there's any kind of karma, though, the interesting third statistic is that 1 out of 3 of those people that indicate or that were surveyed, of these 1,000 people, indicate that they expect that they're going to have to provide for their parents. So it's a little bit of a symbiotic relationship. If these millennials still need money from their parents as young adults, they're probably thinking that it's essentially a loan, and at some point they're going to have to pay it back because their parents may not be able to afford to retire or take care of themselves. So this is a trend that's worth continuing to watch, so stay with us and we'll cover it. All right, up next, Greg Porcaro with Otrando, Porcaro Associates. We're going to be talking about trying to cover your medical expenses in a tax-advantaged way. Stay with us. We'll be right back. Welcome back to the Money Pros. I'm joined now by our tax pro, Greg Porcaro, with Otrando, Porcaro Associates. Greg, thanks for being with us as always. Great to see you.
Good to be here.
So we're going to be talking about healthcare expenses. Now, we've talked about on this show numerous occasions how expensive healthcare is, what a burden it is. There are some provisions. Actually, there are a lot of various provisions in the tax code to try to make healthcare more affordable. We're not talking about the Affordable Care Act and Obamacare and those things we've talked about on the show, those things before. But there are various ways to take advantage of the tax code to make healthcare a little more affordable. Before we get into some of the sort of, I guess I'll call them plans that we want to talk about, and that's really what we want to spend our time on, people seem, in my experience, to be confused about the deductibility on their tax return of healthcare expenses. So can you just take some time to clarify how that all works before we get into some of the other stuff?
Yes, and you're right. There is a little bit of confusing because medical expenses are tax deductible provided they exceed certain thresholds. So if you're under 65, the total amount of medical expenses have to exceed 10% of your adjusted gross income. If you're over 65, it's 7.5%. So if you have a bunch of medical expenses and they exceed those thresholds, the percentage or portion over that amount is deductible. Now you have to itemize your deductions.
That's
in the
first thing right there.
So for most single people, whatever, they're not going to have that anywhere near enough, God willing. And many families don't either, because if you earn $100,000, $120,000, and $90,000, you got to come up with $10,000 or so worth of expenses before you even get a little bit of an increment that would be deductible in conjunction with all your other itemized deductions if you have any. So it's very difficult unless there's a serious problem, which we've seen. Long-term care issues if someone's in a nursing home, a disabled child who has special learning disabilities, there's education-related medical expenses. If you happen to be handicapped and you make modifications to your home that help you get access, et cetera, there would be a potential medical expense deduction there too, but they have to be a lot. Health insurance clearly is in that group, and many people, if they're lucky, aren't paying for their own health insurance.
So do you usually counsel clients and say, you know, hey, give me your medical expenses, we'll check it out quickly, but in most cases it's probably not going to help you? Is that sort of the theme?
Yeah, pretty much. And the ones that we know, we pretty much know that they're going to be the routine co-pays, eyeglasses, hearing aids, stuff like that. That's not going to be enough.
And what about health insurance? This is one where I find clients get confused. Is the premium they pay for their health insurance
is a medical expense? It is deductible. So if you're paying your own health insurance, let's say you lost your job and you're paying through a COBRA plan and the employer is not contributing, then health insurance being as expensive as it is.
Goes to that 10% total.
Right, could easily exceed that amount. And long-term care insurance is also considered medical insurance and medical expense, but there's a formula to determine the deductibility based on age. So it's not 100% deductible if you're younger, and it gets closer to that as you get older.
What if you're paying a portion of your health insurance, you have employee health insurance and you're paying a portion of it?
As an employee,
right.
Most of the time that's going to be done pre-tax through a flexible spending account, which we'll talk about.
So probably not deductible unless there's some other arrangement made. All right, let's talk about some of those accounts that we want to talk about. So there are some other ways to pay medical expenses on a pre-tax basis, which is effectively what you're getting if you're deducting medical expenses, right?
That's correct.
And one of those is an HSA. So I think that's an acronym probably a lot of people have heard, most people aren't familiar with. What is an HSA and how does it work?
Well, HSA is really, I think, an underutilized alternative. It's a health savings account, and it gives individuals who are covered by a high deductible plan, which is very common these days, to put money into an account literally for the purpose of paying for medical expenses either now or in the future. That's tax deductible on their income tax return. And for a single person, that's $3,350 a year. For a family, it's $6,750, and if you're over 50, there's a $1,000 kicker in there too. So could be a pretty substantial deduction, provided again that you're covered by a high deductible plan. High deductible plans range from a $1,300 deductible for a single person to $6,200, I think it is, and for a family plan, it's $2,600 to $13,100. So there's pretty big deductibles. We don't see too many at the $6,000 to $13,000 range, but we do see 2 and 4, 3 and 6. So it's not uncommon because it's a way to control the cost of premium. So a lot of employers will offer high deductible HSA qualified plans which enables their employee to participate in that plan.
So if an employee is not entirely sure if they'd be eligible for an HSA, what would you advise them to do? To talk to their benefits person?
Yes, the company, they will know. The premium usually is designated HSA qualified on the bill, so it's not difficult to determine if you qualify. And most of them have suffered the pain of high deductibles because they're putting money out of pocket. So most employees know what their deductibles are, and the higher the deductible, the more likely it's going to be an HSA plan.
So you can put this money into the HSA. What can you use it for once it's in there?
So this is really the best part about these plans, these accounts. You can put money in. You don't have to use it. So if you want to go to the doctors and pay your small co-pays and prescriptions and glasses, the little stuff out of pocket, that money will continue to grow. You can put that money in there every single year. It grows tax deferred and potentially tax free if you take the money out for medical expenses. So you can accumulate almost like a war chest to offset a potentially more complicated medical problem. So you have an accident and there's a deductible that's, for the hospital, let's say it's a couple $1,000, but you have this account you've been contributing to and there's 15, 20 grand in there, you can take the $2,000 out, pay for the hospital visit that might not be covered by insurance. And now that war chest is there to protect you against the bigger medical problems. Now, but it doesn't have to be used that way. We see a lot of clients, they put the money in and they take it out to pay for the co-pays and all the other things that are not covered specifically by their health insurance plan.
So if you have a family putting in $4,000 or $5,000 a year into a plan, they might just know that they're not going to be able to deduct those expenses because it doesn't meet that 10% threshold that would be required in order to even start deducting.
That's right.
Expenses, and you don't get that that first 10%. No, even if you had enough to go over it. So they might know that they have $5,000 in out-of-pocket medical expenses every year, and this is just a way to pay for it pre-tax, basically.
Right, which is great. I mean, it saves you, depending on your tax bracket, of 20, 30, 40%. Depending on what your adjusted gross income and taxable income is. So it's really a nice way to accumulate funds. You don't lose it. If you pass away, there's a designated beneficiary, so it could go to your spouse or your kids, whatever. So it's almost like a medical retirement account in that respect. And it could be invested aggressively if you wanted to. We don't recommend that because we don't know when we're going to need that money. So we want to make sure it's there when there's some medical expense that occurs that we don't want to take out of pocket.
Where do these accounts get opened up? Do you go to the bank, a brokerage
Well, typically
firm?
It's done in conjunction with the health insurance company, but mostly it's banks. You could do a brokerage firm. There are generally some kind of fees for administration because when you request a reimbursement, you're going to provide documentation that you had a qualified medical expense, and then they would send you a check, and you'll get a 1099 that shows how much you put in and how much you took out. And it's really important that viewers, if they get that, to give it to their tax, their CPA, so they will know how to report.
Because the IRS is getting a copy too.
They're getting a copy, right? So you want to make sure you get the deduction. You want to make sure you clarify that any distributions were properly utilized for medical expenses.
And finally, on HSAs, what happens if you take money out that you didn't have medical expenses to offset?
Well, in that sense, it's taxable, but plus a 20% penalty. So it's like that would be like an emergency situation. You got something come up. We see people, they go through anything that can happen in life, and that's all they have left is to tap the HSA. Well, sometimes you have to do what you have to do, but there's a cost associated with that, and the penalty is greater than the premature distribution penalty attributed to retirement accounts, 20% versus 10. So you got to think about that before you do it. Make sure that really is the last resort.
But it really sounds like if you're eligible for one of these things, you're really doing yourself a disservice if you don't open it up and at least put some money in it.
That's right, because you don't have to hit the maximums. You could put whatever you want. Like you said, if you know you spend a couple $1,000 a year, just put a couple $1,000 in.
All right, sounds like a great tool. Now the next acronym, we wouldn't be in business, right, if there weren't any acronyms, is the FSA. Now what's an FSA? How does it differ from an HSA?
So an FSA is a flexible spending account. The difference is the employer has to sponsor that plan. HSA can be set up independent of the employer. FSA has to be set up by the employer. And that allows the employees to pay or defer a certain portion of their pay for various things. Today we're talking about medical expenses, so in a flexible spending account, you could put up to $2,250 pre-tax into an account that's basically administered by the employer, same reimbursement.
So you haven't set it up independently like you would have.
That's right. It has to be set up by the employer. And that money is, again, income and Social Security tax. So the savings for the employee is even more significant in FSA. Okay. Unfortunately, the threshold is a little bit low at $2,250, but it helps pay for like the simple things, eyeglasses, hearing aids, smaller stuff, and your routine co-pays. It comes right out of your pay week by week. So you don't feel it, it's there, and the only other complication there is that you've got to make sure you don't put in more than you're actually going to use. Now, $2,250 is not a lot especially if you have a family, to consider, co-pays and stuff. But if you put in $2,250 and you don't use all of it, there's only a $500 cushion available. So if you underspend by $1,000, you're going to lose $500.
So this is the old use it or lose it plan.
Right.
Everybody in the family gets eyeglasses, whether you need it or
Whether you
not.
need it or
that
not,
kind of
right.
thing, right?
So you want to be sure, and most people can manage that because the threshold's fairly small. And with that $500 cushion, I think it removes some of the hesitation that I've seen in the past of people being afraid to contribute to it because they don't want to lose it.
And the FSA is not subject to the same high deductibility plan limitations. Any employer could open up, start an FSA.
That's right,
if
and
they
many
chose to?
do because if there's any employee contribution to health insurance, which is very common, they're doing that through a flexible spending account. So that's all pre-tax as well. So they usually add these other features. They used to be referred to as cafeteria plans because they'd be like a menu of things you could pick from that you could participate in. Dependent care benefits up to $5,000, another really good one. Medical expenses, certain other types of things that could be done pre-tax related to mostly insurance and other types of benefits.
So the moral of the story here really is, even if you can't deduct medical expenses, which most people can, there are other devices available to you to really take advantage of the tax code with respect to some of these medical costs you have to pay.
And given the cost of all these things, and they keep increasing, and insurance costs keep increasing, and deductibles keep getting bigger, this is definitely something our viewers should be looking at.
More and more attractive. All right, thanks a lot, Greg. All right, up next we're going to be talking about the loosening to some extent of the rules surrounding 60-day rollovers. So stay with us, we'll be right back. Welcome back to the Money Pros. If you've ever had to roll over a retirement plan, you've probably been confused as to exactly what the rules are, and maybe even a little bit panicked at the idea that if you get some of this stuff wrong, you can get a significant tax and penalty bill from the IRS. So I thought it would be interesting to discuss the fact that the IRS has recently softened its stance on how some of this stuff is handled. Now, I don't want to paint this as anything goes, because the rules are essentially all the same. But there are more exceptions granted, particularly if people get into honest trouble and go afoul of the rules. So let's talk about what the rules are right now. And what we're talking about is moving a retirement plan from one place to another. So maybe it's a 401k to an IRA at another custodian. Maybe it's a IRA at one custodian to another custodian. You move it from one bank to another brokerage account, one brokerage firm to another brokerage firm. Those are all what are considered retirement plan transfers. And they fall into two categories. And one is considered a trustee to trustee or custodian to custodian direct transfer. Now these are pretty straightforward, and this is generally what I recommend you always do. You fill out some paperwork, you send it to the current custodian, and they send the money directly to the new custodian. Now, you can do that as much as you want. There won't be a tax bill, there won't be any penalties, and in a year you could do that 100 times or 1,000 times. I'm not sure why you'd want to do it that many times, but there's no restriction on how much you do that. As long as the check is made payable to the new custodian from the old custodian, you're good to go. The trouble often arises with what's called a 60-day rollover. There's another provision in the code which allows you to actually take receipt of the money. So let's say your old IRA custodian sends you a check for the balance of your entire IRA. Let's say that's $50,000. Well, you have the opportunity in the next 60 days to roll that over to another custodian. And as long as that money is deposited within 60 days from the time you originally received it at a new custodian, there won't be any tax bill and there won't be any penalty. Now, if you don't do it within the 60 days, it's actually considered a distribution to you from a retirement plan, and you're going to owe taxes on the distribution to whatever extent that money is taxable. And if you're under 59 and a half, you're going to owe penalties, 10% of the amount that was rolled over. So it can be a significant tax bill if you're not expecting it and you don't get that 60-day rollover done on time. The problem is, in the past, the IRS has not been lenient when it came to that 60-day window. They didn't care what the excuse was if you went over 60 days. You thought your wife mailed the check and she thought you mailed the check. The check got lost in a drawer. I've even seen circumstances where the new custodian didn't deposit the check on time even though you sent it to them on time. It didn't matter what the circumstance. If the money didn't get deposited within 60 days, the IRS considered a violation of the 60-day rollover, and you would be subject to the taxes and penalties associated with it. The leniency has come in the fact that the IRS has now recently announced that they will be more forgiving of situations where people make honest mistakes. So let's throw up a slide and talk about some of the excuses that the IRS will accept. One would be a death or a significant major illness, which would have prevented you from being able to make that 60-day rollover on time. The next one is severe home damage. Let's say you're impacted by a tropical storm or a tornado or something like that, which disrupts your life. The IRS would accept that as a potential excuse. Another excuse that they'll actually accept now is misplaced or uncashed checks. You didn't receive the check from the old custodian, you lost it, it was never cashed. Those are all reasons that they would accept. The other thing I would point out is that the custodian actually made the mistake. That will grant you an automatic waiver. So they've become much more lenient in that respect. Bottom line is you want to pay attention to 60-day rollover rules. If you don't, the trouble can be significant. All right, up next, we're going to answer a viewer question on making a major luxury purchase. Can they afford it? Stay tuned. We'll be right back. Welcome back to the Money Pros. Let's jump right to the viewer question with a little bit of time left. So we had a viewer write in and ask this question. My husband wants to buy an RV. We really enjoy camping as a family, but I'm worried we can't afford it. We don't have enough money to pay cash and would need to take out a loan. How can we tell if this is something we can really afford? This is a fantastic question. This comes up in real life all the time. So here's my answer to this question. If you're wondering, is this really a good financial move? The answer is an unequivocal no. If you have to finance a depreciating asset, it's going to erode your net worth. But that's not necessarily the only measuring stick. We lead lives where we have to balance our future enjoyment of our assets with our current enjoyment. It's not all about living for tomorrow, it's somewhat about living for today, right? So ask yourself this question. If you take out the loan, the money that you use to service this loan, will it shortchange your other long-term savings goals? If you can make the payments on this loan and you can still put away money toward your retirement and kids' college educations and all the other long-term things that you're saving for, then maybe it's not such a bad idea. Now, again, I have to reinforce, it's not that it's going to help your net worth, but it's all about balance. And if you can do it without shortchanging your future goals, it's not necessarily such a bad thing. After all, if it just means a few less coffees out or dinners out and you're using it for something your family's really going to enjoy, it might not be a bad idea. Thanks for watching the Money Pros. We hope to see you again next Sunday right here. Thanks for watching. Take care, folks. On the next Money Pros, we'll discuss a new survey that offers more evidence that it's harder than ever for millennials to finally leave the nest. We'll also be joined by our tax pro, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. He'll share some tax-advantaged alternatives to dealing with medical expenses. And finally, the IRS is becoming a little more lenient with 60-day rollover rules. Don't miss the next Money Pros this Sunday at 11:30 a.m. on Fox Providence, or watch online at foxprovidence.com.